And so this, when we come over to what Wawa's sharing here, this is across 10 lenders. So it's the average. But when we look at what we're seeing here over the last 30 days is in our 3-year, 4-year, and 5-year, we are seeing an uptick in those fixed rates. And it's like what you're saying, it's what we're seeing reflected here in the bond market. All right. And so while, yes, the Bank of Canada rate has been coming down, which impacts our variable rate more so, we're not seeing that in the fixed. And even on the variable side, we were talking with Nicole last month, and she's talking about a lot of the discounts that you're seeing on the variables have been disappearing for a while now. So the you got to discern through some of the news that you're hearing there and actually look at the numbers, because we're actually seeing those uptick. Right. All right, Matt, talk to me about my absolutely favorite prediction chart here.
Yeah, so this is kind of implied on the repo market, the bond market, the likelihood of how many cuts that we may or may not have. So the top one is last month. This was July 1st. It looked as though that we had a 71% chance to get a rate cut come September, and then we had a 52% chance in January and a 65% chance in March. So it looked like by March next year, we were for sure going to get 2 rate cuts. Unfortunately, economic data came out, and now we have a 67% chance of a rate cut in December, which is not a lock. You know, it's a higher number, yes, but it's still not a lock. And then after that, you know, January, it's an 88% chance. So that's by January, we're for sure going to get a rate cut, but then that's it. That is it. It's going to potentially stay like that until mid next year, barring any economic changes that would cause the market to suggest something would be coming sooner.
Yeah, and so this is important when you have clients that are talking about waiting until the next rate cut or are really basing their decisions on this type of information. You got to let them know that this stuff is always changing. Like we update this slide obviously every month, but even look at what changed there in 30 days. We went from, yeah, maybe you get the 2 to like, yeah, you're not getting 2. You know, 2.5 is where you're at until June of next year at this point. Whereas, you know, the likelihood did increase. Like you said, it's 65% at the end of March next year in our last month's data, that maybe you're at 2.25. Maybe you get that second one, but that dried up pretty quickly. And even our most likely cut there in December at a 67% chance, that's even down from what we were going to get in September originally.
Yeah.
So we were bang on with the hold that we saw there in July. And it'll be interesting to see if we get this one now at a 67% chance that there's that cut. Really now in December, like it's looking like September and October, for those of you that pay attention to those dates, are looking like they're going to be a hold. I mean, it's a coin toss in October, really.
Yeah, and one of the biggest drivers for the Bank of Canada to cut is inflation. In the U.S., they have a dual mandate, so it's inflation plus jobs. In Canada, it's purely inflation. Now, if they see that there's been a massive amount of job cuts in a very short period of time, and they think that it's going to have an effect on the inflation into a deflationary market, then they would make the cut. But their primary focus is inflation. And, you know, last month, core inflation, which is what they look at, is still in the mid 3s, I believe. So they need to get that down to 2. It's still sitting too high.